Welcome to PortfolioCasts, the podcast where we break down real investor portfolios.
In this episode, we're exploring Bill Gates from Bill and Melinda Gates Foundation Trust's portfolio, the key holdings, the concentration, and the thinking behind it.
Mike, we are looking at one of the most significant institutional portfolios in the world today. The Bill and Melinda Gates Foundation Trust is currently valued at $37.7 billion. That is a staggering amount of capital to manage.
It really is, Sarah. And what strikes me immediately is the performance. They are seeing an overall gain of 3.1%. Today alone, the portfolio moved up 0.64%. That is a solid gain for a fund of this size.
It shows that their focus on quality is paying off. They don't just chase trends. They look for companies with massive competitive moats. We can see that clearly in their top 3 holdings.
Absolutely. Their largest position is Berkshire Hathaway. It makes up 29.9% of the total portfolio. That is nearly a third of their entire wealth in one place.
That is a $10.8 billion position. Specifically, $10,853,664,252. It is a massive anchor for them.
It is, but they have been active recently. They actually reduced this position by 9.78%. They currently hold over 21 million shares.
Why would they trim such a core holding? Berkshire is down 0.8% overall for them right now. Do you think they are worried about the valuation?
The P/E ratio is sitting at 15.9. That is actually quite reasonable for the current market. The earnings per share is listed at over $46,000. That reflects the massive scale of the underlying businesses.
The stock is trading at $498.67 today. It saw a tiny dip of 0.09%. But look at that 52-week range. It has been as high as $812,855 for the primary shares.
It is a powerhouse. There was some recent news from Money Show about Berkshire being a top investment idea for 26. It seems Gates still believes in the compounding power of Warren Buffett's empire, even if they are trimming the edges to rebalance.
Speaking of rebalancing, let's look at their second largest holding. That is Waste Management. It represents 17.5% of the portfolio.
This is a classic Gates stock. It is a $6.3 billion position. They hold 28,934,344 shares.
I noticed they trimmed this one as well. They reduced the position by 10.24%. That is a significant move.
It really is. Waste Management is trading at $218.57. It took a bit of a hit today, down 1.06%.
The valuation here is much higher than Berkshire. The P/E ratio is 34.2. Does that concern you for a utility-style business?
It is definitely on the high side. That might be why they are taking some chips off the table. The dividend yield is 1.49%. It is a safe yield, but not a huge one.
The 52-week range is between $194 and $242. They are still up near the top of that range.
There is also news in the sector. QXO is raising $1.8 billion for acquisitions. That could change the competitive landscape. Waste Management is the king of the mountain, but they have to stay sharp.
Their third largest holding is another infrastructure play. Canadian National Railway. This makes up 13.4% of the trust.
This position is worth over $5.1 billion. They have over 51 million shares. It is one of their better performers recently.
They are seeing an overall gain of 4.9% on this one. It is trading at $98.95. It was flat today, which is better than the rest of the market.
They did trim this position too, but only by 5.47%. That is a smaller reduction compared to the other two.
The dividend here is much more attractive. It sits at 2.58%. That is a great yield for a rail company.
The P/E ratio is 18.4. It feels much more balanced than Waste Management. The earnings per share is $7.36.
The 52-week range shows a high of $154. So at $98, it is actually closer to the bottom of its recent range.
That is an interesting technical spot. Some analysts are calling it a favorite pick for 26. It provides a vital service that simply cannot be replaced.
It is fascinating to see this pattern. They have reduced all 3 of their top holdings: Berkshire, Waste Management, and the railway.
It suggests a very disciplined approach to profit-taking. They aren't exiting these companies. They are just managing the size of the bets.
When you have $37 billion, you have to be careful about concentration. These three stocks alone account for over 60% of the portfolio.
That is a massive concentration in industrials and infrastructure. It shows that Bill Gates is looking for stability. He wants businesses that can survive any economic cycle.
Even with the recent trims, these are clearly the pillars of the trust. They provide the cash flow needed for their global philanthropic work.
Exactly. They aren't looking for the next moonshot here. They want consistent earners with high barriers to entry. All three of these companies fit that description perfectly.
Mike, we have to talk about the elephant in the room. Bill Gates is the co-founder of Microsoft, but the trust just slashed that position. They reduced their Microsoft Corp holding by nearly 65%. That is a massive shift for this portfolio.
It really is, Sarah. Even after that huge trim, it still makes up 13% of the total portfolio. It still hold over 9 million shares. Those shares are worth about $4.3 billion. It is interesting because the position is actually down about 8% overall.
And the stock is trading around $477 right now. That is toward the higher end of its 52-week range. The range goes from $344 up to $555. Why do you think they're pulling back so aggressively here?
Well, the price-to-earnings ratio is sitting at 33.9. That is not cheap for a company of that size. We also saw news about Apple partnering with Google for AI features. Perhaps the trust is diversifying away from pure tech concentration. They seem to be moving that capital into more industrial and defensive plays.
Speaking of industrials, Caterpillar is a huge standout for them. It represents over 8% of the total portfolio. That is worth about $4 billion. They did trim this one by about 13% recently. Mike, look at those gains though.
The gains are incredible, Sarah. They are up 32% overall on Caterpillar. The stock is trading at $629.77. That is actually hitting the very top of its 52-week range. It is a classic move of taking some profits off the table while a stock is hot.
It still yields almost 1% in dividends too. Do you see the same pattern with Deere & Company? That is another 4.5% of their holdings. It is worth about $1.7 billion.
Exactly. Deere is a core holding for them. They did not change their position size recently. It has a lower price-to-earnings ratio of 26.9. The trust seems to love these companies with moats. These are businesses that are very hard to compete with in the real world.
I noticed Ecolab is also high on the list at nearly 4%. They have about $1.4 billion invested there. It has been a bit of a flat performer for them lately. They are down about 1% overall in the position.
Ecolab is a steady Eddie type of play. It trades at $271. The price-to-earnings ratio is a bit high at 38.8. But for a foundation, they want that stability in water and hygiene services. It is about long-term sustainability.
Let's look at the consumer side. They trimmed their Walmart position by nearly 8%. But Walmart had a great day today, up 3%. It is trading at $117.97.
Walmart has been a winner for them with a 14% overall gain. It is near its 52-week high of $117. We saw news today about equities rising despite probes into the Fed. Walmart is often seen as a safe haven when the macro environment gets cloudy.
They also have a significant stake in FedEx. That is about 1.5% of the portfolio. They trimmed that one slightly as well. But Mike, the overall gain there is over 32%.
FedEx has been a home run for them. It is trading at $311.92. The price-to-earnings ratio is very attractive at 16.8. That is much lower than the tech stocks we discussed. It shows their focus on value and cash flow.
I want to touch on some of the smaller, more interesting positions. They have about $200 million in Coupang. That is the South Korean e-commerce giant. That one has to hurt a bit. It is down 31% overall.
That is definitely the outlier in this portfolio. Coupang has a sky-high price-to-earnings ratio over 100. It is a much riskier bet than Caterpillar or Walmart. On the flip side, they are up 19% on Madison Square Garden Sports. That is a fun one to see in a philanthropic trust.
It really is. They also have some high-yield plays like Kraft Heinz and Hormel Foods. Kraft Heinz yields over 6%. Hormel yields over 5%. They trimmed both of those positions by about 5 or 6% recently.
They are likely harvesting those dividends while reducing exposure to slower growth brands. Hormel is actually down about 7% for them. Kraft Heinz is down 10%. It is a reminder that even the best investors have positions that underperform.
When you look at the whole picture, what is your final take? We see a $37.7 billion portfolio. It is up 3.1% overall.
It is a very defensive and disciplined portfolio. They are moving away from the tech heavyweights like Microsoft. They are leaning into infrastructure, shipping, and staples. They want companies with high earnings per share, like Caterpillar at $19.
It feels like they are preparing for a more volatile market. They are locking in gains on the winners. They are keeping a lot of old economy stocks that pay reliable dividends.
Precisely. They are focused on quality and competitive positions. Whether it is trash collection with Waste Connections or beer with Anheuser-Busch, they want businesses that will be here in 50 years. It is about protecting the capital that funds their global initiatives.
That is a great place to wrap up our analysis. The Gates Foundation Trust remains a masterclass in institutional diversification. Thank you for joining us for this deep dive into one of the world's most watched portfolios. I'm Sarah.
And I'm Mike. Thanks for listening.
Thanks for listening to PortfolioCasts.
This content is for educational purposes only and should not be considered financial advice.
Any figures, prices, or portfolio values discussed are approximate and used for illustrative purposes only.
Follow PortfolioCasts for more investor portfolio breakdowns.